Show. It's Friday, December 14th, 2018. I'm Steve Houston with Compass Communications, and the year is winding down, and so I'm here again with Joe Terril of Terril and Company to chat a little bit about the markets and investing. And Joe, the markets are about as ugly as the weather is outside here in St. Louis, and every time I open up the paper these days, it's just gloom and doom. So what's your take?
Well, there's no question that there's been a change in sentiment around the world to United States and China trade problems are going to plunge the world into recession. I don't subscribe to that. I don't see that happening. And the doom and gloom of we're going to have a worldwide recession, that'll cause banks to have difficulty, manufacturers will pull back, real estate prices will drop dramatically, that whole domino theory, I just do not believe that that's what's getting ready to happen. And if anything, I think the movements of the markets downward as much as they have, particularly in areas like financials and bank stocks, have more than discounted any bad news that might show up. The prices now are actually getting to a level where there's going to be some nice buys for those that are willing to look past the headlines that are in the paper today.
Yeah. So the Fed is going to meet next week, and they're expected to raise interest rates, and that engenders yet another gloom and doom scenario. But what do you think?
I don't think the Fed raising interest rates next week by 1/4% in any way is doom and gloom. Interest rates a couple years ago on Fed funds were only 1/4 or 1%. Now they're up to 2 1/4 if the Fed raises next week. If our economy can't survive with 2% interest rates, that's a pretty sad statement, and I think it can. The flip side of it is unemployment is the lowest it's been in years. Average hourly earnings of the consumer is going up dramatically. Consumer balance sheets are in the best shape they've been in years. Some people are pointing towards corporate debt and saying, yes, but look at corporate debt. It's high, but corporate assets are even higher. So as a percentage of corporate assets, overall corporate debt actually is lower, percentage-wise. It's like saying, well, the amount I owe on my house is high, but the value of my house is up dramatically, so actually the percentage I own versus the bank is actually higher. So I don't see in the United States the problems, and there are positives out there, particularly employment, people working, people making more money, energy prices are staying down. It's a positive, and therefore I think the Fed can raise interest rates another 1/4% and normalize without destroying the market for homes and autos and such things.
Okay. So looking ahead to 2019, how are you positioning your portfolio?
Well, in the last couple of days, we begin to buy some of the financial stocks that have had some of these major banks are down 25 and 30% off their highs of just a month or two ago. Balance sheets have never been better. They're buying back stock. They're raising dividends. A few of the industrials that are down 33% off their highs. We're beginning to buy some of these things, not aggressively because you don't know how much longer people are going to continue this. But we went into really this year somewhat underweighted in stocks, and we've been underweighted in stocks most of the year. If this keeps up, we'll go into 19 with a more normal stock position and increase our position in stocks. The market believes that interest rates are going to plunge around the world as we go into recession. If we do, I'll be glad to have some of these dividend yields that are approaching 4%. on very good companies. So we'll try and add to positions selectively as prices continue to come down.
Okay. Well, thank you, Joe. That's Joe Terril, founder of Terril and Company, independent wealth management with $720 million in discretionary assets under management. Joe, I want to wish you, your family, and your entire staff here at Terril and Company happy holidays and a wonderful new year.
Thank you, Steve, and same to all of our viewers, clients, and associated people. Best of everything to you for the remainder of December and into the new year. And I feel pretty good that this is not going to continue like this for the balance of the year and into January.
We'll see you in 2019.